Today, we're going to be looking at implied volatility when it comes to options pricing, how to use it, and how to profit from this change in options pricing. So let's watch this video together, mastering implied volatility.
Needs to know. Dare I say this is one of the most important and best options trading videos that I've created, as this video is going to be packed with simple explanations and tons of data visualizations to help you fully understand implied volatility and what you want implied volatility to do when you are trading the most popular options trading strategies. I promise you this video is going to be a game changer for you, especially if you are new to options trading. So let's get started. So first and foremost, what is implied volatility? I think it helps to break these two words down into alternative words to better understand what they mean.
I do want to take a moment before he jumps too deep into this to talk about where implied volatility falls under your options chain. Now, remember, the very first time I ever saw an options chain, I'll never forget the day. And I looked at all these numbers and I said, I have no idea what all these numbers mean. I just want to make money. You probably have felt that same way too. But if you've been watching this for a while, on Options Deep Dive Wednesdays, I try and go as deep as possible. And one of the things that you've probably learned at this point is the difference between extrinsic and intrinsic value. Intrinsic value is the calculation of the price of the stock minus your strike price. So here, 608, let's do the calculation real quick. Hang on. Reset that. There we go. Okay. So if we went to the 602 strike, just picking one at random, 608.89 is current price of Qs minus the 602 strike gets you to redo this because you're a professional YouTuber. 608.89 minus 602. There we go. $6.89. Amazingly, exactly what this shows here. This is how deep it is in the money. This is how worthy it is. This is how much the asset itself has value. Okay, how valuable is the option? This over here is the uncertainty value. So we have two different values here: the worthiness of it, the valueness of it, the moneyness of it, the intrinsic value, which is just a simple A minus B calculation. Extrinsic value is everything else. Everything else. Now, how do you get to the extrinsic value? You literally just take the current price minus your extrinsic value. So 1956 minus 689, and you got 1267. Now, of course, this is kind of wide right here, and this is taking the midpoint of those two. Okay, so that's where that number is coming from, the extrinsic value. So all of the implied volatility value is falling into where? The extrinsic value. Exactly correct. You guys are so smart, because the intrinsic value is nothing more than the current price minus your strike. Everything else goes into the extrinsic. It's the bucket to catch everything. That is your uncertainty value. So what is implied volatility? That is measured by Vega, and that drops into extrinsic value. Everybody got it? Cool. Let's keep going.
So instead of
Oh, Richard, I will absolutely be discussing that. That's a very important concept that we'll be talking about in a little bit.
implied, we could think of hinted or suggested. And instead of volatility, we can think of price movements or price fluctuations. And if we think of implied volatility as hinted price movements or suggested price fluctuations, I think it becomes a much more approachable term. So let's understand exactly what that means. I like to think of implied volatility as the expected or hinted magnitude of a stock's price changes in the future as implied by the stock's option prices.
So here's the deal, right? When you're coming up to earnings, when you're coming up to an anticipated event, implied volatility will expand. When that implied volatility expands, the price of the option goes up, right? Now, if you've bought the option, that's a great thing. If you sold the option, you're getting hosed. Okay. So I'm always looking to buy deep in the money calls, usually around the 80 delta. So I really don't care. And we'll talk about why I don't care so much about what the implied volatility does, because where I live, we're so deep in the money, right? We're so deep in the money. I have to scroll several times, so deep in the money that the extrinsic value is already way down. Let's go over to a different stock. Let's go to SoFi. Now, I have a reason for SoFi. The reason is that I can do a lot of strikes all at once. It's not because I'm a SoFi bro, but SoFi bros for life. It only goes up forever. It's the future of finance, bro. The thing is that at the money is your most highest uncertainty. Your most highest uncertainty. Look, it even pans out to that. Your most highest uncertainty. Now, there are some oddballs here and there, but in theory, it should look like this. Your extrinsic value goes as close to zero as it can. It goes up, it peaks at the money, and then comes back down like this, okay? So this option right here is the highest cost of any option, because this is the one that will decrease in value the most as time goes by, as the extrinsic value goes by. Now, implied volatility spikes and then comes back down. You could even see it spike during the day, right? If in the middle of the day Trump tweets something, right, you're going to see implied volatility spike like crazy. But within a couple hours, people are going to be buying or selling, whatever, managing their positions, and that implied volatility is going to creep back in, and the price of your option is going to creep back down as well, because the extrinsic value, the uncertainty value, has come in. I would bet you, I don't have the data to measure this, but I would bet you, since Trump has taken office, implied volatility across the board has set a new higher level because of that golden toilet tweet type thing, where he can be sitting on, his not porcelain throne, his golden throne, and tweeting, and it can move financial markets. We've seen it already many times. So I would bet that there is an additional level right now as a baseline that there never was during Sleepy Joe's time. Let's keep going.
So really, implied volatility is just looking at option prices on a particular stock, and from the option prices, the options are implying certain behavior or certain anticipated behavior of the stock price in the future. For example, if we look at SPY, which is the S&P 500 ETF, and we see that SPY has a current price of $447. If we look at a 40-day 450 strike call option on SPY, we can see that the price as of this recording was $8. If we go to NVIDIA, which had the same exact closing stock price as of this recording, and we look at that same 40-day 450 strike call,
holy moly. That's crazy. So I appreciate this example here, because he's trying to set apples to apples with the same stock price. He's doing a at the money call here. Look at the difference between the two. In theory, the at the money call should be roughly the same on the intrinsic value, but the extrinsic value is the only thing difference between the two here. Does everybody understand that? I'm glad we started off with the intrinsic extrinsic discussion, because that is 100% extrinsic value here, the difference.
Option, we can see that NVIDIA's call option is trading for $34.50. Now, when I pulled the implied volatility numbers from SPY and NVIDIA, I saw that SPY's implied volatility was 17% and NVIDIA's implied volatility was 60%.
Now, I don't want you to get caught up on percentages. Like these numbers here, I'm telling you for a fact, as a professional investor, I give no monkey donkeys what this actual value is. This means nothing to me, but it does give you some context of which one has more implied volatility. Okay, so he's going to show numbers. I think someone actually asked the question in the chat. I don't remember if we saved the question or not. But across the top in TradeYear, you're going to see implied volatility like that, historical volatility like that, right? These numbers you may use in your plan. It's literally something I don't use whatsoever in my plans. So that's up to you. We'll keep going.
Now, the big lesson here is just to see that from the way more expensive NVIDIA option price, the implied volatility of NVIDIA is much higher. And what this means very simply is that NVIDIA's way higher option prices are suggesting to us that NVIDIA's stock price is way more volatile than the shares of SPY.
That makes sense, right? One of the biggest companies, if not the biggest company in the entire stock exchange, has more volatility than the exchange itself. So let's talk about why that is, right? So the S&P is made up of roughly 500 stocks, right? It's not going to be exactly 500 stocks. If I said 500 stocks exactly, some troll on the internet would be like, oh, actually, it's 509, Chris. Don't you know, stupid idiot? No, I don't care. It's somewhere in the ballpark of 500 stocks. Now, this NVIDIA, see how big it is right here, right? It's bigger than some entire industries. Like the whole consumer defensive could probably fit inside of NVIDIA. And because of that, it's going to have an outweighed impact on the market. Because if, let's say, Costco, which of course I've been giving thousands and thousands of dollars to this month, shopping for Christmas and such. If Costco moves by 10%, no one's going to notice. If NVIDIA moves by 10%, everyone's going to notice, because it is that big, that impactful. So overall, what I'm trying to say is the average price for the, maybe not average price, the S&P 500 is a market cap weighted index. Okay. So as a whole, it should have less volatility because of all the stocks inside of it, right? In theory, if they were all equally weighted, they would have, very small impact one at a time. There actually is one called RSP that is equally weighted if you want to look at that. This is the equally weighted index. Okay, equally weighted SPY. But Morgan Stanley, 40 plus, specialized investment management team. Sweet. But on its own, this stock, of course, any stock is going to be more volatile than a group of stocks. All right, super long-winded answer. Sorry.
I did was I went back 5 years and I made a histogram of the daily percentage changes in SPY and NVIDIA. As we can see, the green bars represent SPY's daily price changes or the frequency of the daily price changes.
Now, what's really interesting about that, this is actually something we have inside of Ovtlyr as well. And part of the way the signals work is looking at that volatility histogram over here. I'm gonna pop off chat for a minute. This volatility histogram right here. Now, his data looks different than our data. I can't confirm or deny his data, but what I can say is that our data right here shows the positive skew of SPY, right? Do we see the positive skew right here? Many days of the S&P 500 are moving up, right? That's why the frequency is so high. And there are some big down days, of course, but to this here, right? We're gathering around a certain point. Okay, we're gathering around a certain point. But if we go to NVIDIA, it's going to look obviously a lot different. Yeah, it's going to look obviously a lot different. We see that down here, right? And that is what he's showing right here, is that the distribution of changes up or down is wider, right? The bell curve of how many times the price changes is wider. So therefore it has greater volatility. All right, everybody following along?
And we can see that the daily price changes of SPY are much tighter, much lower than the daily price changes observed in NVIDIA. So NVIDIA's stock volatility is much higher than SPY's stock volatility, which results in more expensive NVIDIA option prices and therefore higher implied volatility, aka higher option prices on.
Because there's greater uncertainty. Everybody got it? See how this all tracks together here? Greater uncertainty. And where does that go? That goes in the extrinsic value, which is our uncertainty value. Man, cool. Tie it all together.
NVIDIA as compared to SPY. If you're enjoying this video and you want more in-depth content just like this, check out
Hang on,
strategy. Grab your copy. Well, implied volatility is so important because changes in expected stock volatility will have an impact on option prices and therefore trade profitability or performance. What I want to do now is look at option strategy, profits and losses versus changes in implied volatility. So let's explore how popular option strategies perform when implied volatility changes, so we know exactly what we want implied volatility to do when we trade each respective option strategy.
Now, here's the deal. I don't condone, I don't support, I don't encourage any exotic option strategy whatsoever. That includes credit spreads, debit spreads, iron condors, zebra strategies, cover calls, whatever you want to put in there. I don't condone any of those. That's me personally, because in my trading plans, I have evolved to trade basically deep in the money calls. Now, one of the reasons why I trade deep in the money calls is, as you remember earlier, the chart here showing how the extrinsic value increases as it gets closer to at the money, right? If you go deeper in the money, you're paying less for extrinsic value. Okay, just a fact. Just a fact. You pay less for extrinsic value the deeper you go. So I don't really care so much about I don't really care so much about the option prices implied volatility, because I'm already trying to minimize how much I pay for this anyway. Now, let's say that I found one that has really high implied volatility. When I go to get my trade, I'll start around the 80 delta. Let's go for this one here. It's more liquidity. So that's interesting. That one just peaks up right there. Hey, hang on. SoFi's got some stuff going on. Let's go to Qs. Go back to Qs. And let's go to somewhere around the 80 delta. Like right here. This is $5. It's moving a lot. $5 on a $43 option. Okay, so 5.12 divided by 43.60. That's 11% extrinsic value. If I came here and it was, I don't know, 35% extrinsic value, you know what I would do? I'd say, okay, no big deal. Let me just move up, because now this is going to be $4 of extrinsic value. 4.17 divided by 52.98 gives me 7% extrinsic value, right? And imagine if the implied volatility is baked into extrinsic value, and all I'm trying to do is minimize extrinsic value, the only thing I have to do is just go a few more strikes further up. Then I don't even have to worry about it. Implied volatility is going to do what implied volatility is going to do. I've already minimized as much implied volatility as I have to worry about. Okay. So let's continue on here. I'll give you my perspective on these types of option strategies, but honestly, in theory, I don't condone any of these.
Strategy. In the following graphs, we are going to be looking at simulated option strategy profits and losses based on the following inputs. The entry implied volatility for all of these scenarios is 20%. Then we're going to change the implied volatility to 10%, meaning a 10% drop in implied volatility from the time of entry, and also look at 30% IV, which would represent a 10% increase in the implied volatility from the time of entry.
Now, remember, this impacts the at the money options the most. This change up and down is really concentrated and focused in on at the money. Why? Because that's the most uncertainty, right? We don't know with the most uncertainty, we don't know if this one that's at the money right now will be in the money or out of the money at expiration. And again, this peaks and goes down when you go out of the money or when you go deep in the money. Okay. This one has the most uncertainty. So therefore, it will be impacted the most of any of them.
Entry. The days to expiration for all the simulations is 60 days, and we're going to hold that constant, and we're going to look at various stock prices. So essentially, we're just going to look at the profits and losses of popular option strategies based on implied volatility changes alone, assuming no passage of time and at various stock prices. So this first chart is just buy and call options, aka long call options, and we are looking at a 200 strike call option with an entry implied volatility.
Okay, so buying calls. I assume the stock price is $200, and so he's buying an at the money call. Now, again, this is the one that will be impacted the absolute most by the changes in implied volatility. Now, if he were looking down here, it would be a different story, and that's okay. Let's keep going.
We have 20%. As we can see, when buying call options, we want implied volatility to increase.
Now, we want implied volatility to increase because that increases our total value of the option, right? If intrinsic value is going up because we're going deeper in the money, and extrinsic value is going up because of whatever reason, right? It doesn't really matter why, but that it does. That's a great thing for us. That's a great thing for us. Now, you'll notice one thing over here. Wait a minute, Chris, didn't you just say that this one, intrinsic value goes up and extrinsic value goes down? Yeah. Unfortunately, the deeper you go in the money, the less impactful changes in extrinsic value will be. Another reason to go with the 80 delta. Way less impactful when you're all the way at the 80 delta versus at the money, right? This one has like 3-4 times as much extrinsic value. Because of that, it's going to be three or four times as sensitive, I guess you could say, than the one that's deep in the money. Now, one thing that I've tried to do in the past, and it's not worked out, is hey, let me try and get that extrinsic value expansion, because that's what we're talking about here, extrinsic value expansion from implied volatility. Doesn't really do anything. The reason being is because the intrinsic value overwhelms extrinsic value. So let's take a look and see what I mean by overwhelms, right? Let's see right here, right? Oh, this is weird. Oh, there must have been a stock split or something. That's why it's got some like 78s. But we're going to focus in on these whole number changes here, okay? Whole number changes in this section right here. Notice, for every dollar you go deeper in the money, this goes up by $1. Who would have thought, right? Remember, this is the calculation between current price and strike price. But this over here, not really doing all that much, right? So between, $4 difference here, you've only got 40 cents of difference from each of these. So what I'm trying to say is that as you're getting deeper in the money, the intrinsic value will now overwhelm any changes in the extrinsic value. So therefore, you don't have to worry about volatility expanding or decreasing. Will it impact the total price? Sure. But what matters more is your delta value. What matters more is how much it's moving for every $1 deep in the money it is. That makes sense? Let's actually, Cameron had a good question. When there's negative extrinsic, and I bet he saw that on SoFi because I saw it too. When there's negative extrinsic, like this, right? Does that affect the option at all? So the funny story about that is, Cameron, it's really just a math equation here, because remember, it's the current price minus the strike price. And you'll notice if you do the math that it's going to come out with a negative extrinsic. Trust me, Cameron, you're never going to buy it with negative extrinsic. Now, it's just a math thing. It's just a rounding thing. You will never be ever be able to buy it for under market price, because that's basically what it's saying here, is that you're buying it under market price. Just try. Just try. If you can, just try. But it's not going to happen. The market maker is going to recognize, oh, you know what? Dude's trying. In fact, the broker may not even send it. Right? The broker may be like, this is a what is the word I'm trying to say? Like not inactive, not incorrect. I don't know. They're going to say something like the option pricing is wrong on this. You're not going to be able to send the order. So honestly, it makes no difference at all. But let's keep going. It's a good question though.
Meaning that if we buy the call at 20% implied volatility, if implied volatility increases after buying call options, we will have better profitability or slightly lower losses as compared to no change in implied volatility, and especially compared to a decrease in implied volatility. Let's move on to buying puts, aka long puts. In this simulation, we're looking at buying a 200 strike put, again with 60 days to expiration, and an entry implied volatility of 20%. As we can see, just like buying calls, when buying put options, we also want implied volatility to increase, because as we can see in this gold line here, the profitability is better than if implied volatility stays the same or decreases.
So Cameron, this made me think of a trade that I put on years ago called a box spread. Let's I don't know if this will price out correctly, but we're going to try it. So it was selling a call spread simultaneously on the same strikes as selling a put spread. I did this correctly. It should come out. Maybe I didn't do it correctly. It should come out roughly the same. It should come out at 0 basically. So selling a call and selling a put. So okay. So this came in at 96 cents, right? If it's greater than $1 when you sell it, this is a debit. If it came out to greater than $1, which is exactly what happened to me, it's basically arbitrage, right? If you sell a box spread, which is an iron condor on the same strikes, and you can get for a credit of greater than $1. Hang on, I do want to do this correctly. Hold tight. Okay, and then sell. Sell, buy. I'm doing something wrong, but it should be right at $1. And if you were able to sell it for greater than $1, you're actually arbitraging it. Now, the funny part about this was I loaded the boat on it. I went on Twitter and I was like telling everybody I could, oh my God, you can arbitrage this stock. And because at the end of the day, when the trade pans out at expiration, because it's greater than $1 in credit that you've taken in, you actually get to keep everything that's greater than $1. So of course I maxed out everything that I possibly could. Turns out what I did was set myself up in a completely impossible to win situation, guaranteed loser, because of the dividend, which was greater than the amount of credit that was over and above the $1. And so therefore, I tried to unwind the trade as fast as I possibly could once I figured out, wait a minute, there's no free lunch in the stock market. And of course, it took a huge bath on it. But yeah, there's all kinds of fun stuff that you can do with that and options. You don't have to do any of that. You can just stick to the 80 deltas.
So when we buy call options or put options, we are always better off if implied volatility increases, aka there is more expected stock price movement or volatility going forward, because that will lift option prices. And since we own a call or own a put option, inflation of option prices is going to help us regardless of where the stock price is. In this simulation,
and again, he's 100% correct. If you own the call, the total price of the call has both the intrinsic and extrinsic baked into it. So as those increase, you're going to get more value. However, the deeper in the money you go, the less extrinsic value is impactful, and it's all about delta at that point. It's all about the delta.
we're looking at the short strangle, which is a popular market neutral.
Under no circumstance are you allowed to do. I'm not even going to let him talk about short strangle. Nothing personal, but this is a horrible, no good, very bad trade. Why would this be a horrible, no good, very bad trade? Anybody got an idea of why this is a horrible, terrible, no good, very bad trade? I'll give you a idea. Imagine that you did a short strangle on Palantir. Right? Imagine you did a short strangle on Palantir. And let's say you did it right here because you knew that Palantir was going to go sideways, which is exactly what kind of trade this is. We're going to go up a little bit, down a little bit, and sideways, and you make money. But if it goes too far up or too far down, you lose. Yeah, you would have lost ups, and then you'd be like, oh, so this exactly happened to Chris. Oh, this super sucks. I can't believe I'm losing to the upside. Ugh. And then it comes back and it's like, oh, praise Jesus. That's why we had, 25 days to expiration. I knew it'd come back. And then it goes down to the downside. No, son of a bee, not again. Yeah. And Monty's point is exactly breaking, once I find the thing I'm looking for, breaking the golden rule of leverage, which is never put yourself in a situation where you can lose more than you can make. Now, funny part about this is that when you do an at the money strangle, hang on, short strangle. When you do an at the money strangle, the traditional theory is, oh, this is perfect. The traditional theory is that it goes up, down, or sideways, and you make money no matter what until you don't. Okay. That if it breaks up to the upside like this, that's okay. You can adjust the trade. So what you do is you move this out of the money put spread up to be at the money, which makes an iron butterfly, which looks like this. Okay. Or a short straddle, I should say. Now, you've taken in more credit. Awesome. I've taken in more credit. Even though I'm in a losing trade, I can't do a damn thing about it except taking more credit. Okay, cool. But then what happened, and this happened to me so many times. I'm telling you, it's the exact thing happened to me so many times. I would look for a neutral trade. It broke out to one side. I adjusted, trying to think, I was doing the right thing. And then what does it do? It not only does it come right back, but then it blows out the other side. So now I've taken the trade that had a wider profit window, shortened up the profit window, and I got blown out on both sides. Yeah. Ask me how I know. I have the scars to prove it. Let's keep going. I don't want to talk about short strangles. I don't want to talk about short straddles either. What's he talking about here? I don't want to talk about spreads. Now, why no spreads? Okay, spreads are frustrating to me, and I'll show you why. There's two different types of spreads. You can do a short spread or a long spread. We'll do a short put spread, and then we'll do a long long call spread. Right. They have different names for them, but essentially they're the same trade. Short, long call spread. More like this. Long call spread. Short put spread. Do they look very similar to each other? The answer is yes, because they're pretty much the same thing. Over here and over here. The answer is yes, because they pretty much do the same thing. So one of them, you're going to pay a debit. The other one, you're going to take in a credit. It doesn't really matter. Point is that let's say you're doing the long debit spread. So let's say you buy the 27. We're on SoFi. It only goes up. So this makes total sense. You buy in fact, let's do the 80 delta. You buy the 80 delta calls over here. And you're like, oh man, this is great. I love me some 80 delta calls. This random guy on the internet was telling me how great they are. 80 deltas. So for every $1 that SoFi goes up, I'm going to make 80 cents. This is great. But you know what? I really don't want to spend $4.60 on it. Let's you know what? Let's cap how much we have to pay. Let's sell the 27.5. Let's sell the 27.5 against it. Okay, cool. So now my debit in the trade is $1.95. Now you're gonna love this. So the debit in the trade is $1.95. That's the max I can lose in the trade. It was $4.65. Now it's $1.95. Hey, you know what, Chris? That's less risk. It's less risk. That's what you tell us to do all the time. But your deltas just went down from 80 to 15. 80 to 15. So now you have like 4, 50, 30, 45, 60, 75, 5 times less power. You just took your option and you cut it off at the knees and you said, you know what, I want to do a trade that gets me 5 times less money per $1 move in the underlying stock. Please. So you have capped your gains you have capped your losses, but your losses were already capped in the first place. You've just shrank what the total trade could have looked like. So spreads, in my opinion, are super dumb because you're already in a situation when you buy the deep in the money long calls. You're already in a situation where your losses are capped, but your gains are theoretically unlimited. Let's do long call. Your gains are theoretically unlimited. They could go up to anything. Okay. But by doing this, you have said, no, I don't want that. I don't want that. I want to make less money. I still want to spend money. I'm going to spend a little bit less, but I want to make sure that I make a lot less. At the end of the day, that's what a spread is. I want to spend a little less, but I want to make sure I make a lot less. What a great idea. So I don't want to talk about spreads. Certainly don't want to talk about iron condors. F that noise. F that noise. Don't you ever think about an iron condor. Let's see what else he's got.
Though the stock price fell towards and through the put strike price of $20, the put option still fell in value. And this is a perfect example of how you
Hang on.
purchasing slightly out of the money puts at the top of the rally on March 22nd, 2023.
Okay. So he's saying that when GameStop did its thing, or was at the very peak, you were the smart guy who bought the puts at the very peak.
As we can see here, if we're looking at the GME stock price versus the put option that has a 20 strike price expiring in May 2023, we can see that even though the stock price fell towards and through the put strike price of $20, the put option still fell in value.
Okay. So the put, as you would think, should be growing as the price of the stock go. Actually, this is a good part. I'm glad you mentioned it. The price of the stock is going down. Now, put options increase in value as the price of the stock goes down. Okay. However, the put options value went from right under $2 down to 75 cents, it looks like. So you've lost 60%, 50%, whatever, of the price of the option as the price of the stock has gone down. Something's broken here. Right. That is because it was the extrinsic value. It was this value going away. It was the uncertainty value getting less uncertain and getting more certain. And then as it continued to go down, delta, as it went in the money, delta started to gain and overwhelm the extrinsic value. And that's why the price went up. Pretty cool, right? You guys are seeing how this all clicks together?
And this is a perfect example of how you can be right directionally on an option purchase, yet you can still lose money because implied volatility overwhelmed and drove the trade performance. Let's look at what implied volatility did over this exact same period. If we change this lower half of the graph from the puts price to implied volatility, we can see that the stock price fell and implied volatility, which is measuring option prices, actually collapsed. So the collapse in implied volatility is what caused the put purchase to lose money, even though the stock price was declining. And we would think that buying put options and seeing a big drop in the stock price would lose money. So even though the stock price was falling towards and ultimately through the put strike price of $20, implied volatility went from 100% down to about 55%.
So this was an out of the money put. Good point. Good point. An out of the money put. It was a $20 put when price was at $24. Okay. So then it went in the money. Okay. That makes a lot of sense why the implied volatility would be so impactful on it. There was a good question here. I have a good grasp on options. Mr. J Dunn Candid Android. Candidroid? Can Android. J Dunn Droid. Okay. Mr. Droid. This is not the droid you're looking for, though. I have a good grasp of options, but I'm still struggling with the IV crush, both making absolute sense, but also being extremely confusing at the same time. So let's think about it, right? If we have earnings coming up, implied volatility is going to be super high. Let's go to Palantir when it had earnings. Implied volatility is going to be super high because we don't know where it's going to go. Right. So the market makers juice up the implied volatility, juice up the extrinsic value. And they don't know if it's going to go up or if it's going to go down, but they're going to cover their backsides as market makers. All right. They're going to make sure you pay extra for the privilege of trading around earnings. So after earnings, our implied volatility, our extrinsic value is now going to be way less. Because remember, that's the uncertainty value. Before earnings, uncertainty is super high. After earnings, certainty has come down considerably. And this can happen within an hour. within from 8:30 Central to 9:30 Central, you can see implied volatility just get absolutely destroyed. That will change the extrinsic value. Even if the price of the stock goes nowhere, especially if the price of the stock goes nowhere, implied volatility, extrinsic value will absolutely collapse all at once. So it's really a function of, is there greater uncertainty or is there less uncertainty? So after earnings is a perfect example of why it gets crushed right after earnings. Good example. Okay. Um, okay. Food station. We went over this on a recent video. I think that actually comes out right after this. So I hear what you're saying, but always remember that this value declines on a daily basis. The more that you pay for this, the more you will watch evaporate from your account day after day. And I actually went into really good examples with spreadsheets and everything about why the at the money option is actually tremendously more expensive than the deep in the money options. And it has everything to do with the percentage of the extrinsic to the total cost, which in this case is, 90% extrinsic will decline versus this being 17% extrinsic, give or take, will decline. So on a per day basis, you're losing, I'm gonna use some rounding here. On a per day basis, you're losing about 7% of your options value versus 70 basis points, 0.7% of your options value. You're not wrong. I just need you to understand that even though this costs more out of pocket, costs less out of pocket versus this one, the amount that you're going to lose in your value of your asset on a daily basis is significantly higher.
Which is a massive decrease and ultimately led to a losing put purchase trade in GME. And this is because implied volatility on meme stocks is typically positively correlated with the stock price. This means that if the stock price goes up, so will implied volatility or the amount of premium in the option prices. So in this highlighted region, GME stock price went from $18 to $27, but we saw implied volatility in GME go from 60% to over 100%. And
okay. Leading up to earnings and things like that, you'll see the implied volatility growing. After the earnings, you'll see the implied volatility drop. Rogers 1975. Rogers 1975. By the way, Steve, I'm glad y'all enjoy that because I try and make it fun. When I can't read the usernames, like Rogers 1975 says Ivy Crush is real. I opened an Amazon option just after earnings. The next day, the value dropped. Yeah, for sure. That's exactly what we're talking about. Exactly what we're talking about. So you didn't do anything wrong. It's just options have a lot of complexity to them, and it's really important that when you get into options, you understand those type of things, right? Now, granted, had you gone with the deep in the money option, it would have made a very small impact. And out of the money or at the money option, it will make a huge impact. So I would assume that was either at the money, maybe slightly in the money, or out of the money that had the overall impact for there. But I appreciate you, Rogers A, sharing that with us. Jun Dekendoid, Mr. Android, C3PO. There you go. There you go. Jun Dekandroid is now known as C3PO. Thank you for your explanation, and I've got it. But the IV seems more like a heads I win, tails you lose situation. No? How about we just not play the game? How about we just not play the game? We go deep in the money. We don't have to worry about it. That seems a lot easier to me. Wait a minute. Did somebody say Outlier University?
Are you ready? Are you ready? Let's go!
Respect is earned. Respect is never given.
I appreciate the super layup on that, Brandon. You're a rock star for that. So Outlier University is our way to give back to you. We want to teach you everything you could possibly know about trading, and it is happening right now. We're right in the middle of Bravo class. We're taking a week off for Thanksgiving right now, but we're right in the middle of Bravo class. Now, the reason being that we want you to be successful, right? Outlier is priced unbelievably low. It's 82 cents a day, right? There are people who charge you $12,000 a quarter for all the stuff that we're going to give to you for free as an outlier. You can watch live or absolutely 100% free, not even 82 cents a day. The replays will live on YouTube forever. The reason we want to do this is we want you to be successful. When you are successful, we want you to become an outlier. That's the reason we're doing this, okay? We want you to be successful with no strings attached Go be successful. Go make as much money as possible. But be sure you tell everybody that you learned it from Outlier. Now, 50% of you are going to listen, and it's going to go in one ear and out the other. You're not going to do anything with it. 25% of you are going to listen. You're going to implement something, maybe even talking about implied volatility here. You're going to go buy an option. It's going to get crushed implied volatility. You're going to say, Chris made me crush my implied volatility on my SoFi shares. And you're going to say, you know what? Screw this guy, Chris. He doesn't know what he's talking about. The other 25% of you are going to listen. You're going to make the changes. You're going to make the implementation, and you're going to create generational wealth, masters of the universe money in the process. The choice is yours. Okay. And like I say, 100% for free. People charge $12,000 a quarter and don't even give you near as much as we're talking about. 100% for free on YouTube. So that's what Outlier University is. And I want you to be successful by doing it.
Mean 30-day implied volatility as provided by a website called alphaquery.com. Since implied volatility typically surges on these meme stocks, if you are buying call options on those meme stocks and the stock price surges and implied volatility explodes because traders are buying the options in a frenzy, then you can see an explosion in the profitability of your call option purchase. So imagine if the stock price is at 100 and implied volatility is at 50%, and the stock price goes up to 120 and implied volatility goes up to 100%. Based on this simulation, the call price would go from a little over $10 to almost $60.
Now, this is actually really, really cool, right? Let's say you're buying a meme stock. SoFi is definitely not a meme stock. SoFi is the future of finance, bro. I'm telling you, SoFi only goes up. There's definitely not dozens and dozens of people who just make videos about SoFi talking about how it's the greatest stock of all time because they're not involved in memes, of course. All they're doing is recognizing this is the future of finance and you better get in while you can, okay? You better get in while you can. But anyway, even though it's a meme stock, one of the reasons why, if you buy a meme stock as the meme stock is memeing, right? As the meme stock is memeing, one of the reasons why you do so well on the options, SoFi bro for life, SoFi forever. That's right. SoFi doesn't suck. You suck. Sorry, Ned. I'm just joking around. SoFi bros. Yeah, exactly. One of the reasons why you do so well is because the uncertainty grows. And so the call options that you're buying, as it's running up, not acting like a meme stock whatsoever, it's the future of finance. As it's running up like crazy, your options are not only increasing in intrinsic value, but they're also increasing in extrinsic value, which is why you can do even better on meme stocks if you time them right, even though SoFi is not a meme stock. SoFi for life.
Which would be almost a 6x in the value of the call option. So just understand that when traders are buying options on meme stocks, you can have super profitability because of the increase in the stock price.
That's a great point. Super profitability. Super profitability. It's real.
Combined with the increase in implied volatility when the stock price goes to the moon. If you enjoyed this video and you want a copy of all the slides in PDF.
Oh, we're done. Okay, so let's recap. So implied volatility goes into your extrinsic value. At the end of the day, extrinsic value declines day after day after day. As you get closer to expiration, extrinsic value will decline. So it's a temporary high, basically, if you want to think about it like that. It's a temporary high from whatever is happening out in the marketplace, be it on that stock, in that sector, in the market, or even Trump tweets, can have a temporary high that increases the extrinsic value. Intrinsic value is not impacted whatsoever. The deeper in the money you go, which is where I live, you don't have to worry about it because it's already itty bitty baby numbers to begin with. And those baby numbers might grow a few cents here and there. And that's about it. Right. So I don't want you to overstress about implied volatility. Just if it's a thing for you, figure out what extrinsic to ask ratio you're comfortable with. Like, for example, let me show what I mean by, for example, here. Extrinsic value of, I don't want that one, 41 cents on 525. 0.41 divided by 5.25 means that this value has 7% of the extrinsic of the total value is extrinsic. 7%. It's not going to go from 7 to 70% when extrinsic value explodes. Just not going to happen. Okay. It might go from 7 to 12% and then it might come back down. But at that point, you should be so deep in the money that you're making way more money on the intrinsic change than on the extrinsic change. Okay. So at the end of the day, don't stress about it. Don't worry about it. Just Keep with your plan. Hopefully, I've convinced you at this point your plan should involve deep in the money long calls around the 80 delta. It can be the 70 delta, it can be the 90 delta, right? It's really all about liquidity once you get deep in the money. That's where you need to go. So, anyway, if this has been useful to you and you're looking to save time, make money, and start winning with less risk, click one of these two videos and have a happy Thanksgiving. We'll talk soon.